As always, the views expressed during today's webinar are those of the speakers, not of Stratford, the speaker's firms, or clients, and are not intended to provide legal or tax advice. We have gathered a panel to discuss rules and regulations impacting ESOP transactions, DOL guidance, financial structuring alternatives, options for post-transaction adjustments, and other critical issues associated with structuring ESOP transactions. Our panel today includes David R. Johanson, Senior Partner at Hawkins, Parnell, Thaxton & Young, and he is joined by Roberta Casper-Watson, Partner at the Wagner Law Group. And when you're ready, Roberta, we'll get started.
Okay, thank you. I'm happy to be here, and welcome to the audience. I think we have a very interesting program for you. I'm going to go kind of quickly through the overview and give you an idea of the environment in which we work, and then we'll talk about some technicalities. This is a program about ESOPs, Employee Stock Ownership Plans. ESOPs are governed by ERISA, the Employee Retirement Income Security Act of 1974, and they're also governed by many provisions of the Internal Revenue Code. The ERISA issues are overseen by the Department of Labor, mostly by its Employee Benefits Security Administration, which I call EBSA. A lot of the people who work there call it EBSA. Don't quite understand why, but EBSA is shorter. EBSA will take calls from ESOP participants and beneficiaries, and it handles random or targeted investigation. If they see something they don't like, they'll refer it for civil litigation. That goes to the solicitor's office, or sometimes even criminal prosecution. I'm not sure where that goes. I haven't had that happen to me. But it can if you have a bad guy. The Office of the Chief Accountant at the DOL is in charge of 5,500 filings for ESOPs and other plans. The Office of the Solicitor represents the Secretary in litigation matters.
Hey, Roberta, I'm just going to jump in for a second, just for a quick comment. I have defended people in criminal litigation involving ESOPs and ERISA plans, and some of those guys aren't necessarily bad guys either, but there's a whole process, and it usually involves the U.S. Department of Justice working with EBSA and the solicitors. Sorry, just trying to give a little color there, Roberta.
Okay. Yeah, that would make sense that it goes to justice if it's criminal.
Yeah.
There is DOL guidance under ERISA. Some of it is just things that have no particular precedential value, but some of it is official and binding. There are regulations. There are final regulations, including their interpretive bulletins. There are some proposed DOL regulations that have been published in the Federal Register that haven't necessarily been finalized. The EBSA's website contains a list of various kinds of guidance, including advisory opinions, prohibited transaction exemptions, field assistance bulletins, information letters, technical releases, and EO 12866 guidance.
And Roberta, there, just a quick comment. As you know, and as your firm knows, the DOL proposed adequate consideration regulations back in May of 1988, and
right.
last I checked, Roberta, it's 30 years later, and they're not final yet. So
I'm sure I would know if those were final. I've been watching for it for 30 years,
yeah.
but the proposed regs do become useful as a reference point. I think most people ignore the proposed regs at their peril. I know I certainly pay attention to those proposed regs when I'm dealing with an adequate consideration question.
Yeah, I do as well, Roberta, and I do alert the clients to that. That said, I will note that some of the provisions in there, they don't continue to apply, like the provision that used to allow companies to have a partial sale to the ESOP and then have a controlling sale later on and have that deal done at control value. They do not support that. The Department of Labor does not enforce that. So it's interesting how some of those things have and have not been interpreted, but I do agree with you. They're a good guideline for someone involved in an ESOP transaction. Roberta.
Thank you. If a mistake is made in doing administration or a problem occurs where a correction is warranted, the department has a voluntary fiduciary correction program. There's 19 specific transactions for which if there's been a breach of fiduciary duty that they can be corrected. You do that by filing with the department through their program. Also, if you're late on your 5500, there's a delinquent filer voluntary compliance program that can be used to get up to date. In each case, you're probably going to have to pay a sanction of some sort in addition to making the appropriate corrections. The general law that governs, the general law of ERISA that governs ESOPs as well as other ERISA plans has two fundamental prongs. One is the exclusive benefit rule, which basically requires that everything done to administer an employee benefit plan has to be done for the exclusive benefit of the participants and beneficiaries. Also, sometimes it's expressed as having to be in the best interests of the participants and beneficiaries. And it's to provide them benefits and for payment of reasonable administrative expenses. It is okay to pay administrative expenses out of the plan. The other prong of the fundamental rule is that everything has to be prudent. It has to be done with the care, skill, and diligence under the circumstances then prevailing that a prudent person acting in like capacity and familiar with such matters would use in the conduct of an enterprise of a like character and with like aims. It's kind of those two provisions are part of our Bible of ERISA. Most of the time, a fiduciary is only liable for its own breaches. However, there are times when you can have ERISA co-fiduciary liability for somebody else's breaches. And that can occur if you have knowingly participated or concealed an ERISA violation, or if you've enabled another fiduciary to commit the breach, or if you have knowledge of another fiduciary's breach without reasonable efforts to remedy the breach. And it's important to be careful if you're an ERISA fiduciary. You want to be very alert to situations that might make you liable for some other fiduciary's breach. Even if you're very careful, not everybody is. The way the ERISA fiduciary standard of care applies to ESOP plan sponsors, one, they are usually the legal plan administrator of ESOPs, and the plan administrator has a great deal of discretion and responsibility under ERISA for the operation of the plan. Note that the plan administrator is not the same thing as the third-party record keeper. Typically, the third-party record keeper who actually handles the accounting is only a service provider. And a service provider is not a fiduciary. The service provider can perform functions that the fiduciary needs to be done and can perform them for the fiduciary, but the fiduciary responsibility for those functions rests with the legal plan administrator unless some other fiduciary has been appointed properly to take charge of those responsibilities.
And Roberta, let me jump in there if you don't mind.
Yes.
There are a lot of cases, and in addition to working on implementations of ESOPs and doing transactions, we've defended ERISA fiduciaries in litigation for many decades now. And there are a lot of situations in which the plan administrator or some other potential fiduciary who might have otherwise had fiduciary responsibility properly delegates that ERISA fiduciary responsibility to a third party, documents it in an agreement, and then kind of pushes to the side and lets that party do the task. So it's really important, if you want to avoid ERISA fiduciary responsibility, which in closely held companies, I think that's a great idea to just avoid it altogether. Bring in an outside professional, and in fact, Roberta, I think your firm even does that now. You do special independent fiduciary engagement, so that's a place.
Yes, we do.
Yeah, I strongly advise clients to avoid fiduciary responsibility altogether and just simply delegate it to somebody else so they're not involved. Thanks, Roberta.
Yeah, no, sure. Thank you for your input. And note, however, that the party who brings in an independent fiduciary or any fiduciary, including the plan's normal trustee, is always responsible for fiduciary conduct involved in the selection, appointment, and monitoring of the fiduciary. When you bring in a fiduciary to perform a function, as long as you appoint them prudently and monitor them prudently, they should be the only ones liable for their own screw-ups. However, yes.
Sorry. Just one quick comment there, if you don't mind. And this becomes an issue in ESOP litigation and ERISA litigation involving ESOPs, because if let's say I'm the I'm the selling shareholder, and as a corporate officer, a member of the board of directors, I go out and conduct a search and find a great professional like your firm. Let's say we hired, Wagner Law Group, which is one of the best in the country in this area, and we hired you as an independent fiduciary. If I'm also the selling shareholder, from a legal perspective, I think it's that duty to monitor cannot be applied the same way to that selling shareholder, because if they get involved in monitoring, then they could be questioned for having interfered with the transaction in the first place. And I don't expect us to answer that question, but I have a strong view on that, Roberta. I just wanted to jump that in as we were talking about that. Thanks.
Yeah, no, I agree. That's touchy. A lot of the independent fiduciary work we do, it's because somebody else has a conflict of interest and can't do it, and the party with the conflict of interest is probably not the most unbiased monitorer of the independent fiduciary. Lots of times, though, a company can arrange for somebody who's not conflicted to be the one actually doing the monitoring, and lots of times it's the company really that's responsible for the appointment and monitoring. Of course, the individual performing a fiduciary function can have fiduciary liability as well as the legally named fiduciary. But the company is usually the one with overall responsibility, and often the company can find somebody to do the monitoring. As counsel to the company, I have sometimes performed most of the monitoring activities for an independent fiduciary. I did that in a transaction a couple of years ago where we brought in an independent fiduciary because for a sale of an ESOP company, because the officers were hopelessly conflicted, and so I helped them with the selection, and I helped them with the monitoring, and kept them apprised of things, and it all worked very well. And they didn't have to be doing things that they were conflicted or overlooking the things for which they're conflicted.
Yeah. And Roberta, that's a great idea in my opinion, because many of these transactions you have outside independent corporate counsel who is actively involved in helping make sure that the transaction complies in all material respects with ERISA. So I really like that idea, and I've seen that with many corporate counsel being involved to make sure that works properly. I think a better way to do it probably is, or another way to do it is simply bring in a monitor to monitor the fiduciaries who's been appointed by the individual people who selected the fiduciary in the first place, but that's not always possible in closely held company situations. So nice conversation.
I often find that, I mean, in theory, I agree with you. I often find that just the idea of paying an independent fiduciary is a tough sell. And the idea of paying both an independent fiduciary and somebody to monitor the independent fiduciary is a non-starter as far as, you know, clients that are concerned with costs and that sort of thing. And but you know, I mean, it depends on the circumstances. If the conflict is horrific, and if there's nobody who's not conflicted in the picture, then it could be suicidal for them not to bring in an outside person to monitor the independent fiduciary. But anyway,
agreed. And I in many cases where the company has the financial wherewithal, we do advise the corporation to bring in an independent individual or someone of that nature to monitor the fiduciary that's been selected by the conflicted folks. I strongly agree with what you just said, Roberta.
Yeah, I've never had a case where that would have where I would have been allowed to do that. But I think that's great that sometimes you can. And you know, it's a matter of, I mean, a lot of these things, you look at the situation and determine how conflicted are they. It may be a technical conflict that you need somebody else making the decision, but the conflicted people still are not, there's somebody in the picture that can do the monitoring. Other situations, the conflict is so adverse that you just need them not to touch it. So, you know, in real life, things aren't always as clean cut or open and shut as we like to think. We have to make close calls.
Yeah, and that's another good point. And I think you may be getting to this, but just to underscore it, ERISA, if you don't take fiduciary action, that's also a defense under ERISA. Just don't take the fiduciary action. I mean, you obviously you don't want to be a named fiduciary and not realize you're a named fiduciary. But if you're not a named fiduciary, there's no document appointed you as such, and you don't take fiduciary action, that's a good defense as well, Roberta, in my opinion.
Although sometimes a fiduciary action has to be taken. An example I recently ran across was a situation where an ESOP-owned company, the CEO basically tentatively negotiated a sale of the company without the participation of any of the other board members or anything like that, and just came and basically handed it to them in their lap, and he was going to get a good deal as a continuing employee of the buyer. And they had to do something. They couldn't just say, "No, we don't feel like it." They had what was potentially a very good deal to sell the company, and nothing was binding until they made it binding, but they had to figure out what to do with that situation. So, if selling the company to a certain buyer or a particular purchase that you have in mind would be a fiduciary duty and you don't want the liability for it, maybe you can pass on it, but every now and then life hands you something you can't just punt on. There are certain things that fiduciaries cannot do called prohibited transactions. It involves buying or selling something with a party in interest, lending money, furnishing goods and services, transferring something to or for the use by for the benefit of a party in interest, any assets of the plan, an acquisition on behalf of the plan of an employer security in violation of Section 407 of ERISA. These things are basically prohibited. Now, there are a number of exemptions. There are some statutory exemptions. There are some class exemptions that the Department of Labor has already decided what the conditions would be and published them, and so you can act as long as you meet the conditions. You can go ahead and act on them based on what's published, or you can get an individual exemption. One of the toughest things is the fiduciary self-dealing transactions, which are basically involve conflicts of interest or use of plan assets for the benefit of a party in interest. and for those things, the standards for exemptions are very tight and have to be very careful. And this is often a situation where you end up bringing in an independent fiduciary. Sometimes there are transfers of real or personal property from a plan to a party in interest in a sale or exchange, and there are some exemptions that allow that. In particular, there's a specific exemption that allows the sale of employer stock or employer real property to a plan, and there are conditions associated with that. And if you meet the conditions, it is legal to purchase stock or real property, or to sell it, including to a party in interest. One of the main requirements is that the ESOP can get a bargain, but the ESOP can't give a bargain. The ESOP must, in a sale, the ESOP must get at least adequate consideration, and in a purchase, the ESOP cannot pay more than adequate consideration. Section 314 of ERISA defines a party in interest, and it's a very broad definition. The ESOP plan sponsor is always a party in interest. All the named fiduciaries of the ESOP, the employee organization whose members are covered by the ESOP, employees, directors, officers, 10% or more shareholders. Service providers are usually an ESOP, such as the ESOP trustee. ESOP trustees, incidentally, are very often directed. I mean, the ESOP trustee has certain inherent responsibilities if it has the title trustee. The Department of Labor has made that clear. But the ESOP trustee often isn't the one with investment discretion. There's often some other fiduciary that has that discretion who directs the ESOP trustee, in which case the ESOP trustee may be more of a service provider than a fiduciary, even though it has some inherent fiduciary functions. Family members of individuals who are parties in interest are often attributed to the party in interest and are also parties in interest because of the relationship. Section 407B of ERISA provides that there's a 10% limit on a plan's investment in qualifying employer securities. 407B of ERISA provides that does not apply to individual account plans, and that includes ESOPs. Individual account plans, I've always called them EAPs, eligible individual account plans. Sometimes a profit-sharing plan or a 401k plan that is not an ESOP can buy and sell employer stock and can hold employer stock. And I've had a number of those over the years.
Roberta, on that front, I have done the same thing. I think EAPs are a really good device to use if you don't want to use the ESOP form for a profit-sharing plan or some other form of retirement plan, and I think they become very helpful to clients who want to get creative in the design of an employer security-based plan.
I find those aren't so popular anymore these days. The clients that I had that did that all got rid of them. And I haven't had anybody want to add company stock for quite some time. I mean, I'm sure it's still being done in the right circumstance, but for a number of years, I had, basically all my big public companies had EAPs, basically 401k plans that could invest in stock, and they weren't ESOPs. And then just over the years, they all kind of stopped doing that.
Yeah, Roberta, we've got probably at least 10 large companies throughout the country, and typically it's in an engineering or architectural professional environment, and they like the flexibility they have to try to create an internal market for the stock using an EOP without having an employee stock ownership plan. So we found it to be a very useful tool, and those plans have been in place for some of them for a couple of decades.
Yeah. Well, I'm aware of some that have been in place for many decades. Some of them even predate ERISA, I think. Some of the big retail chains that becomes a way they can reward what they call associates, their employees for long-term service, and some of them do really, really well. You can have like a cashier who retires after 30 or 40 years with a good solid seven-figure account balance. Section 408A of ERISA authorizes the DOL to provide administrative exemptions, which can be either class exemptions or individual exemptions. As I said, once a class exemption is published, anybody can use it if you meet the conditions. The individual exemptions you have to go after specifically. There is a program called the X-Pro that if a whole bunch of people are getting the same exemption, then you can get expedited treatment of it. Otherwise, I'm told it takes a while to get an individual exemption. It's been a while since I've asked for one, although I've got a couple right now that are in process that we may very well request. But it sort of boils down to if something is important enough and is adequately protective of the participant's rights, that's not an excuse to just do it without an exemption. But it may be a reason to get an individual exemption with the DOL telling you what the conditions are for the exemption. Section 408B2 of ERISA permits ESOPs to enter into reasonable contracts or arrangements for necessary plan services. That's good because a service provider is automatically a party in interest. It would be, technically, I suppose they're not. It's not a prohibited transaction until they become a service provider, which they don't until you negotiate the first contract. But if you couldn't keep updating your contract with your service providers, a plan would have trouble operating. So there is an exemption to allow reasonable contracts or arrangements for necessary plan services. 408B3 of ERISA permits ESOPs to borrow funds to acquire shares of company stock. The loan has to satisfy a number of conditions. It has to be primarily for the benefit of the participants and beneficiaries. It has to have no more than a reasonable rate of interest. It limits collateral for the loan to shares of the company stock that are bought with the loan or the earnings thereon, or contributions made for the purpose of repaying the loan or the earnings on those contributions. Usually there aren't a lot of earnings on the contributions because they go in and go out pretty fast. But what you can't do if an ESOP already has a number of shares of employer stock and it's buying another bunch of shares, you can't pledge all the ESOP stock as collateral for the new loan. Only the stock being purchased can be pledged as collateral plus the earnings on that stock and the contributions made to repay the loan. DOL Regulations 408B3 of ERISA impose additional conditions. There's a share release formula. There are certain put option rights that have to be offered. There are certain accounting requirements that must be followed. Section 408E of ERISA permits employee benefit plans to acquire shares of company stock if the stock constitutes qualifying employer securities, and there's a definition for that in 407D4. The purchase price cannot be more than adequate consideration. No commission can be charged with respect to the transaction, and if the plan is an EAP, or otherwise will not acquire more than the limit on investments in company stock under 407A of ERISA, the ESOP ESOPs do constitute individual account plans. You get out of the 10% limit on employee stock if the plan is an EOP, and an ESOP is an EAP. In terms of what's adequate consideration, the ESOP cannot pay more than fair market value for the shares, or if it's selling, it cannot receive less than fair market value. fairness, the overall yeah, you want to talk about fairness, David?
Yeah, if you don't mind, I'm going to talk about adequate consideration too.
Sure.
It's really important that that process is run by the independent fiduciary. So sometimes people make foot faults. They should try to avoid them. They should first go through the process of selecting a qualified independent fiduciary and or ESOP trustee. I, again, recommend that companies and selling shareholders and officers don't get involved in that process, and they essentially have an outsider come and become involved. But then that party, the trustee or independent fiduciary, and again, that's something that a firm like the Wagner Law Group does, would then establish the fair market value of the stock of the company based upon an independent appraisal from a third-party independent appraiser and financial advisor who has never done any work for the company whatsoever and who is qualified and has accomplished a number of ESOP valuations in the past for comparable situations. In addition to I'll just quickly jump into a couple of comments on fairness and then jump back to you, Roberta. In addition to and what has to happen is you have to have that adequate consideration fair market value opinion as of the day of the transaction. The valuation report that's required in addition to that does not have to be done as of the date of the transaction. That's something that typically happens within a period of time after the deal closes. But on top of that, we strongly advise our corporate clients to make sure that there's a fairness opinion involved in an ESOP transaction. And there's two levels of fairness. One is the adequate consideration or the fair market value test. That's what Roberta and I just talked about. The second level of fairness is looking at the overall transaction. What benefits are inuring to executive compensation or executives in the way of executive compensation, for example? Any kind of terms, let's say there are warrants for the benefit of the selling shareholders. Other provisions that might benefit parties other than the ESOP, those are all fairness issues that need to be looked into by the trustee and by the independent appraiser and financial advisor, and typically we make sure that there is a fairness opinion that says that all of those other arrangements, stock options, executive compensation, warrants, etc., are fair to the ESOP from a financial point of view at the time of the deal. Thanks, Roberta. Just wanted to jump in there and highlight a couple of those issues.
No, thanks for doing that. I want to backtrack just for a second. Regarding the prohibited transactions, one of the questions that comes up regarding the handling of the collateral is it comes up sort of at the end. What happens if you sell the company and you want to use the proceeds of the loan to repay the loan? And sometimes the loan's only been in existence a short time, and it would be a huge windfall to the participants to have to pay off the loan from company contributions and also get the full amount of the purchase price for the company, which includes, from the buyer's point of view, the buyer has paid for all of the shares, including those that aren't allocated yet that were purchased by the loan. And so there's a question of the extent to which you can use the proceeds of a sale to repay an outstanding loan. I encountered this early in my career, and you can find out what the DOL thought of that idea in Advisory Opinion 93-35A, or you can find it in a database if you just plug in my name. It's the only one. It's the only advisory opinion that I've gotten that was actually addressed to me. Basically, the department's view at the time was that the ESOP, the trustee, has a fiduciary duty to stiff the lender. The circumstances of that were that the lender and the trustee were the same bank, And in the no good deed goes unpunished category, the bank did not want to have the ability to foreclose without going through some other fiduciary. So it declined to have a perfected security interest, thinking that then its repayment would have to be handled by some other plan fiduciary. And so when the company was sold, we asked the Department of Labor. By that time, the DOL had started to make some noises about maybe you couldn't do this, and so we asked for a ruling. It took us 4.5 years to get the ruling. But they ended up saying that basically there just might be a fiduciary duty for the trustee to decline to repay it, seeing as how there's no security interest in it. Now, a federal district court later, several years later, upheld that ruling, but its circuit court overturned it. I've forgotten which circuit that might be in. It might be the 7th. So that ruling is not fully in force, but it's still an issue that may be concerning to somebody who's setting up an ESOP. And what I do, I mean, I of all people, having gotten that ruling, should have some strategies for dealing with it. And what I do is I never fail to perfect a security interest. The security interest is always perfected, no matter what kind of conflict of interest circumstances it might create. Also, I try to avoid having the plan commit the employer to paying the loan. The employer can still pay the loan, make contributions to be used for paying the loan, but I try not to require in the plan that the employer do that, because that sets up an obligation of the employer that somebody could argue the ESOP is fulfilling for the employer by using the proceeds to repay the loan. And there are other things you can do, like I'll put provisions in the plan document that specifically say what happens in the event of the sale of the company. Specifically say that the proceeds will be used first to repay the loan. And so some of those things can prevent the kind of quagmire that we got into with my client, for whom that advisory opinion was obtained. In that case, there wasn't other money to use to repay the loan. So it really mattered that we be able to do it with the proceeds of the loan, and it was really a problem that the DOL stopped us from doing that. Anyway, back to where we were. There are a number of settlement agreements that the department has worked out with some banks that kind of have become the DOL's articulation of some principles. David, why don't you tell us about those?
I will tell you briefly about them. I do respect the folks who entered into the negotiations to accomplish these settlement agreements, but my mentor in this business, Ron Ludwig, who really was one of the premier ESOP attorneys of the first generation of ESOP lawyers, always didn't like the fact that the DOL tried to accomplish by either regulation or other purposes, litigation, the regulation of ESOPs without Congress passing laws. And I think that's what I put these category of settlement agreements in. And by the way, I've been involved in defending the fiduciaries that were involved in a couple of the Alpha Investment Consulting Group cases that's listed here, that settlement agreement. I defended the fiduciaries, not Alpha, in those cases, but Alpha was a co-defendant in those cases. Anyway, I think these agreements, they're useful, but I think you should, focus on the content of these agreements, but they are not law, and they shouldn't be treated as law and they're not even regulations, because they haven't been proposed as regulations with a comment period, etc. So I do think they're important to know they exist, important to get copies of them, read them, understand what they include, but they're really just settlement agreements that typically say they can't be admitted as evidence in any kind of litigation whatsoever. They simply will just alert you to things that the Department of Labor thinks are really significant in ESOP transactions. So to the extent you use them for that purpose, I think the process agreements are good. Don't feel like that when you do an ESOP transaction, you have to comply chapter and verse contents of these settlement agreements or these process agreements, because they're not law. That said, I think a good educational tool. They're not binding on other parties other than the ones that were involved in them. Great Bank Trust Company, who was involved in a lot of litigation over the years, finally entered into a process agreement to end its litigation with the Department of Labor. First Bank Trust Company, First Bank Trust Services had the same situation and decided to enter into a process agreement with the DOL. Again, they resolve the issues between those companies and the Department of Labor. They're not binding on other parties, but they are useful for understanding what the Department of Labor thinks is significant when selecting an independent ESOP trustee or independent ESOP appraiser and financial advisor, when reviewing and accepting an ESOP valuation for purposes of a transaction, and other transactional due diligence and negotiation procedures. So that's basically all I have to say about it. Roberta, you can add whatever you'd like at that point.
No, I agree. They aren't law. And by the way, the Department of Labor, it's not unusual for the Department of Labor to lose cases when it's trying to assert its principle and get them incorporated in the case law. Sometimes the department does get ahead of their skis. On the other hand, these settlement agreements, along with other guidance that the department has out there in various forms, when you're designing compliance, quite frequently there is no earthly reason to do something that you already know the Department of Labor doesn't like. Life is often simpler if you just do things by the Department of Labor's guidelines, if you can. I mean, sometimes there's an important objective that the department has made impossible and you can't, and you have to do a risk analysis on it. But lots of times you really can follow all these things, and so, you know, when in doubt and you're in the planning mode, you may well wish to go ahead and use whatever guidance there is as to the DOL's thoughts and go ahead and comply.
I agree with that statement, Roberta. Again, there's no point in trying to fly in the face of what the DOL thinks is required. There are some cases where they're just flat out wrong about it, and that's in litigation and outside of litigation. But that said, it doesn't hurt to review this information, understand it, know what's included, and try to abide by it if it makes sense to do so in a particular case.
Right. Conflicts of interest are constant in managing ESOPs. You must always be alert to where there's a conflict of interest, somebody who may have an interest different than that of the plan participant. And for the most part, in the ESOP arena, you need to eliminate that conflict of interest in the making of the decision that affects the ESOP. Now, ERISA in general contemplates that people with conflicts of interest will be ERISA fiduciaries and will be making decisions on behalf of the plan and the participants. For example, the employer can make certain settlor decisions on its own and for its own purposes, and the employer is often the legal plan administrator, and that's fine. People who are related to the employer are often the trustees, and that's fine. And as long as they wear their fiduciary hats when they're making fiduciary decisions, the whole concept of ERISA recognizes that will be happening, and accepts that people who have a potential for a conflict of interest are still capable of taking off their employer hat or their self-interest hat and putting on their fiduciary hat and acting for the best interests of the participants and beneficiaries. Fiduciary decisions must all be made for the best interests of participants and beneficiaries, even if you have a conflict of interest. But in many cases in ERISA, it's accepted that people will, and they do, put on their ERISA fiduciary hat and act appropriately. The ESOP arena, however, is fraught with opportunities for conflicts of interest to really turn into self-dealing, and in situations where even the best-intentioned fiduciary wearing its fiduciary hat, if it's conflicted, nobody's going to believe after the fact, if something goes wrong, that the decision was made without being influenced by the conflict of interest. For example, if you're a fiduciary selling stock to an ESOP, it's perfectly legal as long as the conditions are met for the ESOP to buy stock from a fiduciary. However, you shouldn't be acting for the ESOP in that deal. It raises the issue of using plan assets for your own benefit, which is a separate prohibited transaction all by itself, and nobody's going to believe that you really had the best interests of the ESOP at heart if it turns out that the ESOP overpaid for the stock. So it's really important in terms of corporate governance. You need to carefully assign the responsibility in government for the ESOP, particularly in a company that's solely owned by an ESOP. You want to have your corporate governance body be separate from the ESOP governance body, and you want to make sure that each party to a transaction retains separate advisors. The company may have its advisors, but the ESOP should have its own advisors, because there are certain routine situations that employers probably aren't going to abuse, that you don't have to overdo the added cost. But for the most part, you're going to need to have the ESOP have separate advisors on anything that's the least bit sensitive. The ESOP is going to need its own experienced independent trustee or other fiduciary. You may have a directed trustee and you have a separate independent fiduciary directing the trustee. But you want to make sure that there is an experienced independent trustee representing the interests of the ESOP participants and beneficiaries. And also the ESOP trustee should engage an independent appraiser and financial advisor for the ESOP, and that should be somebody who has not provided any services for the company or the board of directors or the non-ESOP selling shareholders. So independence should be very strictly determined in these situations where you need it. So the ESOP trustee should have an independent appraiser and financial advisor for the ESOP. And now it's not necessarily that the rules require that these positions all be independent. And it's not unusual for a company that is very fiduciary oriented in its thinking to have its own entities doing these things. But if there's a controversial action being taken, even those companies should separate everything, and a best practice is to separate them from the outset, so that when something controversial comes up, it's very helpful if you already have an independent trustee who already meets the standards of independence and who can act without any conflict of interest on behalf of the ESOP, and if that trustee already has an independent appraiser and financial advisor. David, this is your corporate governance chart. You want to explain it?
Yeah, just quickly, because we are a little bit off target in time here, so I'm going to quickly run through this one. Thank you, Roberta. All this chart is intended to show is the unusual nature that you get involved in when you have corporate governance in an ESOP corporation, because basically the board of directors elects the ESOP trustee or appoints the ESOP trustee, but then we turn around and that ESOP trustee, you see the box up above on the left-hand side where the ESOP trustee manages the ESOP trust. Well, that ESOP trust in a majority-owned ESOP company is probably going to end up electing or appointing the board of directors. So there's a circular process of corporate governance, and one has to be really careful with this. It's important, in my opinion, to avoid any real conflicts here, to have a nominating committee on the board of directors that sets forth a slate of qualified directors for the ESOP trustee to elect each year. And also, it's really important to have outside outside disinterested members of the board of directors to be involved on that nominating committee and then the whole corporate governance structure. Otherwise, you just have a circular corporate governance structure here that really doesn't have any outside parties involved, and I think it's really important. So that's really the essence of that slide, Roberta, just a quick dialogue. There are a few slides after this. I could briefly go over this one, Roberta, as well. The ESOP trustee, its job, there's a lot more that Roberta has talked about here, but the ESOP trustee's job is to elect and monitor the board of directors of the company, to vote the shares that are owned by the ESOP. They're responsible for, except to the extent it's been delegated to the corporation as the plan sponsor, they're responsible for the administration of the plan and potentially the administration of the trust, and they establish the fair market value of the company's stock. Whereas the board of directors, on the other hand, is responsible for major corporate actions, strategic planning for the company, and all business-related decisions. Those are not primarily ESOP trustee functions. The board of directors does appoint the officers who run the company on a day-to-day basis, and they do typically appoint the trustee, the independent fiduciary or trustee who is responsible for ERISA fiduciary as it relates to the ESOP. And then the officers run the business on a day-to-day basis. Thanks, Roberta.
Do you want to discuss slide 25?
Yeah, just quickly. These are just for everybody's benefit. These are committees that I think are really important on an ESOP corporation's board of directors. The nominating committee I already talked about. I do think it's important to have an ERISA fiduciary committee on the board of directors, and that should consist of people who are independent. A lot of people are independent, but the question is, are they disinterested? Disinterested members, outsiders, would be a good idea to have on the ERISA fiduciary committee. Then they can be responsible for selecting and monitoring the ERISA fiduciary. That's just a best practice. It's important to have an audit committee who is responsible for, even if you don't have an audit, responsible for the reviewed financial statements of the company and approving them. And then an executive compensation committee, which would go out and hire an executive compensation consultant who would determine the reasonableness of executive compensation in an ESOP company. I think that's critically important. Those executive compensation issues become important in almost every ESOP transaction in ESOP company. And then finally, you might have an ESOP communications committee which works with employees of the company and it's really not a fiduciary committee, it's an entity that figures out how the ESOP works and how best to communicate that with the ESOP participants as a whole. Thanks, Roberta. I think I don't need to go over this next one, so I think we can move on given our time. If you want to take it from there.
Okay, sure. And the ESOP does need a trust, which is a separate legal entity to administer the plan. The trust will be the record owner of the shares, and the participating employees are beneficial owners of company stock. It's important to remember that although the employees are the beneficial owners of what's in their account, they are not the direct owners of employer stock. The trustee is the owner of the stock. Now, the trustee, as mentioned earlier, may or may not be the one who has the fiduciary responsibility for making buy and sell decisions. Somebody may direct the trustee, but the trustee is the one that holds the stock for the benefit of the participants and beneficiaries. So whenever an ESOP is created, a trust must be established and a trustee must be appointed, and the trustee must be monitored, particularly if the trustee is doing fiduciary functions. The actions of the trustee are governed by ERISA, and the trustee is subject to the prudent person standard, which is the highest standard of care in the country. The ESOP trustee may be an inside person, a director, officer, or employee of the company, or a committee of them. You may have an independent trustee. Banks, trust companies, professional individual service providers, there are some independent fiduciaries who will be ongoing trustees for companies. The authority of the trustee, they'll either be directed or discretionary, and if they're directed, then it's important to pay attention to who is doing the directing, because that person has important fiduciary responsibilities. This is a chart of the parties and advisors, and I'll leave that for your review. David, you want to talk about the financial structuring alternatives?
Yeah, I will. Thank you, Roberta. And we are kind of, we only got about 17 or so minutes left, so I'm going to buzz through a lot of this stuff because I think there are some important things still to get to. I want to make sure we get to, structuring a leveraged ESOP transaction. We get to Section 1042 tax deferrals, but I'll start with financial structuring. Thank you, Roberta. There typically are a number of different sources to fund an ESOP transaction. We've got on here senior bank funding. That is not really available to many of the closely held companies that are out there because many of the closely held companies that are out there don't have fixed assets. They are a lot of times service companies, and if you're a service company, you don't have assets to take to a bank to secure lending. And by the way, I thought Roberta's comment about security and dealing with security and ESOP financing is really important to make sure that it's properly documented. But anyway, we've got senior bank financing on here. It is a potential source of assets to finance an ESOP transaction. It doesn't happen as often in these days after the Great Recession as it did before the Great Recession, but it still is available when you've got hard assets to pledge as collateral by the company for the loan. Secondly, you do have a lot of second lien lenders. The senior lender is the one who gets the first priority security interest in the assets of the company. The second lender or second lien lender or junior or sometimes they're referred to as subordinated lenders, they typically will come in without security after or get a second priority security interest in the assets, and they are providing some much more expensive financing. A senior lender these days, you could get financing 3-4% potentially. A second lien lender or a junior lender, you're looking at sometimes 10, 12, 15%, but in some cases that makes sense. What I've seen most of these days is seller financing. Seller financing is a nice way to finance an ESOP transaction where the selling shareholders, the founders of the company, just simply extend a promissory note or extend financing by accepting a promissory note from the ESOP as the purchase price. And if there is it is good if you have some cash, if the company's got some cash to pre-fund the ESOP so that the ESOP can pay some cash for the transaction. That's also another good way to approach it. But seller financing is very popular. And then on top of that, you may have senior management get involved in the funding of the transaction. You may have something called warrants. Again, warrants are, let's say that a selling shareholder decides that he or she is going to make equity or make financing available to the ESOP, so accept a promissory note from the ESOP with the stock as collateral, the stock that's sold as collateral for the debt. If that happens, sometimes warrants are warranted, for lack of a better word, where the selling shareholder could get a zero or a hardly very low priced warrant to purchase stock in the company at a certain very low price in order to supplement the financing return that the seller's getting on the seller financing. That's one of those things where I said it's very important to get a fairness opinion from the independent appraiser and financial advisor for the ESOP to say that those warrants are fair to the ESOP from a financial point of view. That's not fairness related to fair market value. That's fairness related to the overall transaction. Very rarely do we have employees get involved in financing ESOP transactions. I'm going to jump over this next one. Just quickly say that one of the most significant things here is, make sure that you model the cash flow of an ESOP transaction and financing before you go into it, even if it's not outside lender financed. If it's seller financing, make sure you have an ESOP feasibility study. Hire a competent professional to assist you in kind of laying out the cash flow associated with the ESOP, the tax and other advantages that can help make it happen, the impact of the transaction on the corporate financial statements. They're basically a contra equity account, and model the cash flow to make sure that the transaction will prevail when you have a downturn in the financial markets. I mean, you're never going to be able to predict the Great Recession kind of a downturn. It's really difficult to, but you should predict a 10, 15, 20% downturn. I'm going to jump over just because we've got a lot of things to cover now. So I'm switching over now to slide 34 just to show you the structure of a typical leveraged ESOP transaction. And again, we've got an outside bank in here. With an outside bank, the bank would loan money to the corporation. The corporation would reloan those funds to the ESOP Trust. ESOP Trust would use those funds to buy stock from the selling shareholders and then pledge the stock, again, to the corporation for that loan between the corporation and the ESOP Trust. As the corporation then makes tax-deductible contributions to the ESOP Trust that are used to repay that internal loan between the corporation and the ESOP Trust, the corporation can get a tax deduction not only for the principal, but for the interest and potentially for any deductible dividends. That's covered. The issue of principal and interest deductions are covered under Section 404A9 of the Internal Revenue Code. The dividends are also covered under Section 404, and you can declare and pay reasonable dividends on the stock that's held by the ESOP, the corporation can, and use those dividends to essentially repay the debt that's incurred to buy the stock in the first place, and the corporation can get a deduction for that. It can only be used with respect to the stock that was incurred for that particular loan, like Roberta had talked about earlier. The only other thing, and then you could have a seller finance transaction where the debt here is between the non-ESOP shareholders and the ESOP Trust, and the corporation. Then typically what happens with a seller financing ESOP transaction is that after the deal closes, there's a refinancing of the debt so that the corporation owes the debt to the non-ESOP shareholders, and the corporation, I was trying to use my pointer here, but the corporation then would have an internal loan between the corporation and the ESOP Trust, and that allows the corporation to make tax-deductible contributions to the ESOP Trust and repay that internal loan, have the ESOP Trust repay the internal loan and create tax deductions that way without having to pay money that goes out of the corporation to the outside shareholders. The rest of this, again, given our time constraints, I'm going to jump over to another topic, which is the Code Section 1042 tax-deferred ESOP transaction. This was very, very significant in the 1980s and 1990s and even in the 2000s. For a while, companies and their founding shareholders kind of moved away from this type of a transaction, but I still find it to be a very useful transaction to encourage selling shareholders to sell to the ESOP, and that's why it was put into the law back. Section 1042 was put into the law by Congress back in 1984. and it's been in the law since then. Hasn't basically changed that much since then, but basically what it allows the selling shareholder to do of a closely held C corporation, there's been efforts to make this applicable to S corporations as well, but to allow a shareholder of a closely held C corporation to sell qualified employer securities to an ESOP and defer the capital gains taxes on the sale of those securities if he or she reinvests the proceeds from the sale of such securities into stocks or bonds of U.S. companies within 1 year after the transaction takes place. The purchase of the QRP, the qualified replacement property that defers the capital gains, can occur 3 months before the sale to the ESOP as well. Typically what happens is the QRP, the qualified replacement property that helps accomplish the tax deferral, has the same carryover basis that the selling shareholders had in the company stock, which is typically pretty low. So if there are any sales of that QRP, that would trigger what's called a recapture of capital gains, so you don't want to do that. That said, there are ways that you can transfer the QRP securities through some form of estate planning that would avoid, through a gift that would avoid the recapture of capital gains. And then what typically happens in these Section 1042 tax-deferred ESOP transactions is that the seller tries to buy what's typically referred to on the market as floating rate notes. They tend to be hard to come by these days because they're often sought after in order to defer taxes on a sale like this. But if the seller holds on to the floating rate notes until the seller's death, the QRP will pass to the seller's heirs with a stepped up basis for tax purposes at that time, and then the selling shareholder basically avoids taxes altogether on the sale to the ESOP. So, and if you think about this, and I'm going to talk a little bit more about it, if you're in a high tax state like New York or California, you still can have an advantage of close to 35% on a sale to an ESOP versus a sale to a third party without an ESOP being involved. And that can be the piece that kind of tips the balance into convincing the selling shareholder to sell to the ESOP or to sell to the ESOP at potentially a bargain purchase. The qualifying employer securities that you need to sell to the ESOP, they have to be not readily tradable on an established securities market, so we can't have publicly traded stocks being sold here. They have to be common stock with the best dividend, best voting rights of any class. It can be convertible preferred stock that's convertible to the best dividend and best voting rights common stock of the company. One key point you need to understand about Code Section 1042 is the selling shareholder cannot have received stock that he or she sold to the ESOP in an incentive plan, for example, a stock bonus plan, a stock option plan, an executive compensation plan of some kind. And the selling shareholder must have held the stock for 3 years prior to the sale in order to take advantage of Section 1042 of the tax code. That's not a big problem, though, because typically, let's say that you had a membership interest in a LLC that owned stock in that owned an interest in a company. You could contribute that membership interest to a corporation. That's way beyond the scope of this presentation, but there are ways to create a tacking of the holding period from holding of other assets or membership interest into the stock of a C corporation to take advantage of Section 1042. I'm going to jump through this because I've already hit all of these requirements as I went through. I don't think I mentioned this yet, but the ESOP must own on a fully diluted basis at least 30% of the company after the sale. That's critical in order to accomplish the tax deferral. And I already talked about the 15-month period. There are limitations. This just simply gives an overall dialogue. There are limitations on what kinds of stocks or bonds or debt you can invest in. It's got to be stocks or bonds of a domestic operating company. It excludes real estate investment trusts, mutual funds, passive investment companies, and mutual funds, mutual bonds, and mutual funds. The one way around this that's a legitimate way is to form a corporation that was not in existence and in the same controlled group of the ESOP corporation at the time of the original sale. And that's been done throughout the country. Invest the proceeds from the ESOP transaction into stock of that corporation, and then use that the cash in that corporation to enter into some of the investments that otherwise founding shareholders would want to do. So this is, there are great creative planning ways to deal with a lot of these issues. Again, I'm moving quickly because we're running out of time here, but I wanted to get through a couple of other things. This basically talks, this slide 46 talks about what long-term capital gains are right now. So if you're a selling shareholder, without an ESOP, you got a 15% to 20%, depending upon the selling shareholder's tax bracket at the federal level. You got 3.8% Affordable Care Act, Medicare investment tax, the ACA tax, and then you've got to deal with state and state taxes as well. So you've got a series of taxes that you're going to incur. This slide just shows that you can avoid that with the ESOP transaction. This next slide simply goes through an example of a Code Section 1042 tax-deferred ESOP transaction taking $1 million and how you essentially sell it. If you get the step-up at basis, let's say that you sell $1 million worth of stock to an ESOP, you buy qualified replacement property equal to $1 million, you reinvest that, it grows to $1.5 million at death. The basis gets stepped up to $1.5 million at death, and there's no tax on the selling shareholder then. So you can potentially avoid the taxes altogether on the sale of stock to an ESOP. This does encourage a lot of closely held owners of companies to sell stock to an ESOP. The next, given time, I'm not going to go through that one. The next one, I did mention that in high state tax jurisdictions like New York and California, you can easily save or defer 35% of the sale proceeds by selling to an ESOP. The next one I'll quickly go over is installment sales to an ESOP, and we're getting ready for the Q&A, but I want to cover a couple more slides if that's all right, Kelly. The installment sales to an ESOP, that's something you could do, and if you didn't want to defer your taxes under Section 1042, you could just take the proceeds from the ESOP as you get the, let's say again, you accept a promissory note secured by the company stock. You accept that from the ESOP as your proceeds. You then report under Code Section 453. You report the principal and interest received each year upon receipt, and you pay hopefully pay long-term capital gains rates on that stock as you sell it, or on those proceeds as you receive those proceeds, and you pay it whatever the rates are at that time. You will also pay state taxes, and a lot of selling shareholders just simply like the simplicity of an installment sale under Section 453 instead of the Section 1042 tax deferral. I like to make sure that selling shareholders and corporations understand both alternatives. There is a $5 million caveat. You cannot have, in order to take advantage of this Code Section 453, kind of report your gain as you go. You do need to have less than a $5 million promissory note. So we've structured a lot of transactions where the promissory note is less than $5 million, and just tried to deal with it that way. Kelly, I know we're into the Q&A. I can keep going if you'd like, or I hope you're there, or we can jump into the Q&A. Your call. I've got a couple of other tax issues I could talk about if you wanted. Don't hear Kelly, so I'll keep talking for a couple of minutes. There are a couple of questions I want to make sure we reserve time to answer at the end. They have been there, and I do want to get them answered, and I'll jump into them next. Roberta, I hope you don't mind. I'll jump into tax liabilities to companies here, if that's all right.
Fine. That's fine. Please.
Thank you, Roberta. The federal court, for years, I was trumpeting the great tax advantages associated with ESOPs from a corporate perspective, and so I would talk about the deferral taxes on the selling shareholder side of 35%, 37%, and then you could talk about a comparable deduction of 40 to 45% on the corporate side. Then we had the new tax bill this year, which generally decreased federal corporate tax rate from 35% to 21%. Doesn't mean there's not the same advantage with, not an advantage, tax advantage with an ESOP, but it just means instead of getting at a federal level a deduction of 35% on the dollar, you get a deduction of, or you get a savings rather of 21% on the dollar, which still is a dramatic savings for a C corporation ESOP. There is a 20% deduction for qualified pass-through entities, so that's another way that taxes have reduced for entities, corporate and LLC type entities. There's an interest deduction limit of 30% of EBITDA now, so that is something that's kind of cut back on the ability to take advantage of the ESOP deductions that used to be available, immediate expensing of capital expenditures, and then you've got the repatriation, which really doesn't apply here. But I guess the other thing I want to say about taxes before I go on, Roberta and I go on to the Q&A for about 10 minutes, is there is a design of an S corporation ESOP that is quite advantageous, because what can happen is with an S corporation ESOP now, and I don't have the right slide up. I'll see if I can get to it. I don't have it up. But anyway, with an S corporation ESOP, if you accomplish an S corporation ESOP transaction, and let's say, just for example, this is just an example, the ESOP owns 60% of the stock of the corporation. What happens is now, because of a law that was passed back in the 1990s that became permanent in 2001, in June of 2001, to the extent that the ESOP owns a corporation, to the percentage of which the ESOP owns the corporation, the ESOP is a tax-exempt entity. So if it owns 60% of a corporation, then you essentially are avoiding taxes on 60% of the income of that corporation. If you go to 100%, and there are many large, closely held S corporations, fully owned, wholly owned ESOP companies out there that are S corporations, now they don't pay any taxes whatsoever. In California, they pay a 1.5% tax rate, but that is another major tax advantage associated with structuring an ESOP transaction in an S corporation. And a lot of times what happens is a selling shareholder will sell to an ESOP in a Section 1042 transaction, defer their taxes with a C corporation, and then have his or her C corporation be converted to an S corporation. Roberta, I'd like to run to the questions if we could, because I think we only have about 10 minutes left. Can we do that next?
Sure, that's fine.
Okay.
All right.
I'm going to hit, Kelly, I'm going to hit the first one, and I may hit the second one, but then let Roberta have her thoughts on that. I think I only see two, but there may be more that I missed.
There are four.
Okay. Roberta, I'll take the first one and maybe jump into the second, and then you can hit the other two if you'd like.
Okay.
It says here, and certainly feel free to add to my answer to the first question, but it's talking about a merger transaction involving a non-public company where the ESOP is a minority shareholder, and state law does not require that all shareholders approve the merger because a single non-ESOP shareholder has majority control. Are ESOP participants still entitled to vote on the merger with respect to allocated shares pursuant to Section IRC 409E? If the law is actually that, I mean, that's not typically the law, most states don't have a law that says that if you're a minority shareholder, you don't get to vote. But if the state law truly says that, that is a potential for 409E not to apply. I really would have to look at the actual statute to understand what the statute reads, because most of the times, even though you're a minority-owned ESOP, the state corporation statute does say that the participants get to vote on a major corporate transaction like a sale of all the assets, a liquidation of the corporation, the sale of substantially all the assets, or a merger with another entity. So it's a good question. There is a potential that there's no voting applied, but it's the devil's in the details of the state corporation statute there, and I can't really tell you without seeing that state statute. And the next one.
Well, David, I've actually been through this fairly recently. The federal rule is that whatever situations state law gives the shareholders the right to vote, if those happen while there are still shares in the ESOP, then the participants do get a right to vote those, and that's a matter of federal law, but what issues the vote is allowed on. If what happens is something that state law doesn't require a vote, and I think this is how I read the person's question. If state law does not require a vote on the particular transaction that's happening, then the trustee is solely the person to vote it. The participants don't get that passed through.
Right, and Roberta, I agree entirely with you, and that's why I really need to look at the statute to understand what the statute says and if it requires a vote or not in that situation. And that's what I would do to really answer that question properly. I'll quickly go on to the next one, and you can jump in on the next one, Roberta, as well. In the merger transaction, it says in the above merger transaction whether or not the ESOP participants are entitled to vote on the merger. Are individual ESOP participants entitled to exercise individual dissenters' rights with respect to allocated ESOP shares? Again, Roberta, you may have something to add, but I really think it's critical to look at what the state statute says as to whether or not those voting rights, those dissenter rights rather, are applicable. And dissenters' rights are just gives someone the right to dissent to the actual transaction that occurs. Do you have any thoughts on that one you want to add, Roberta?
Yes, I've been through this a number of times. I don't think it's clear whether dissenters' rights automatically get passed through, but I've had plans that very carefully passed through voting and other rights regarding the shares, and we concluded that dissenters' rights was one of the other rights. So I have actually gone through administering, getting participant elections on dissenters' rights, and I did that the first couple of times in the days before the internet could be used for such things. It was a very cumbersome process. But we did it. In terms of whether there are dissenters' rights, that, like voting, is totally a function of state law. If there aren't any dissenters' rights, then the participants don't get the right to, make up some form of dissenters' rights. But if there are some in the state, then I don't believe that the federal statute automatically requires that those be passed through, but the plan might, and the employer might want to pass them through as an exercise of its fiduciary duties.
And I would add to that, I agree that I don't think they typically are, but I would draft it as a corporate attorney. I would draft it, generally speaking, not to have this. As you say, there may be some fiduciary issues involved. I don't know what they may be in a vacuum, but you certainly can address this from a plan drafting stage at the outset. And I can tell you that over 3.5 decades, we've never drafted one that created that right voluntarily. But I understand you may have some clients that have done that.
Well, I don't know that it was created deliberately in the ones where I dealt with it, and I wasn't the one who wrote the document, but they were being very broad in passing through voting and other rights, whatever that means. And we concluded that it meant dissenters' rights, that it included dissenters' rights. I don't know what else it included because that never came up, but we did think we had to pass through the dissenter's rights, not because of the law, but because of the plan. Excuse me.
And I would say there, I would carefully draft the plan to avoid that confusion on the issue, and we have carefully drafted the plan not to make it that broad to envelop dissenters' rights. You want to cover the next couple of questions?
Sure. In a sale transaction for the purchase of 100% of the shares held by an ESOP in which the ESOP owns 100% of a non-public company and there are multiple bidders, must the ESOP trustee or other appointed ESOP fiduciary always approve the sale to the highest cash bidder, or could other non-monetary factors be considered, assuming the sale bids are reasonably close to one another, for example, within 1%, and the share price represents adequate consideration? No, you do not have to necessarily choose the highest bidder, and in fact, whether you choose the highest bidder or not, you should have reasons other than price for why you've chosen a particular bidder. I mean, there may be terms you may have. I know the question asks about a cash transaction, but you may have terms that require that the buyer be creditworthy, and you may have a difference in creditworthiness of the bidders, or you may have companies with bad reputations as to how they manage the shareholders' assets, or there could be a lot of reasons why one player is considered kind of a bad guy and is making an inflated offer, and you don't have to necessarily take an offer from somebody that you don't think will be a reliable party to the transaction. However, in that situation where you're not taking the highest bidder, you better have a real good reason for it, and it requires a very careful fiduciary process. I've had this happen. Back in the mid '80s, there were, or maybe it was the '90s, there were green mailers going around and making offers for corporate stock with the intent to take over a corporation, typically a bank or a savings and loan, and basically rape it and leave the creditors stranded. And I had a situation where a green mailer was trying to acquire the stock of my ESOP, and we had to very carefully figure out what to do with it, and it was very, very difficult.
Roberta, I'm going to jump in to add on to what you just said about this third question. I think you handled it great, and I wanted to add one other thing. In a lot of ESOP sale transactions, what I've witnessed as corporate counsel is that the fiduciaries are trying to get some incremental amount in excess of fair market value. So you said it very aptly. If you're going to accept the price that's not from the highest bidder, you better have a great procedural prudence process from the ERISA fiduciary side to make that decision, because you're going to be questioned about it potentially down the road. Again, I've seen a lot of those sale transactions where the trustee negotiates a premium above fair market value in order to protect the ESOP and to show that the fiduciary has done its job as an ERISA fiduciary.
And I've seen the negotiated premium strategy too, and that's a good thing to do. Assume a sale transaction for the purchase of 100% of the shares held by an ESOP in which the ESOP owns 100% of a non-public company. Within 6 months prior to signing the stock purchase agreement, former ESOP participants had their ESOP shares purchased in accordance with the plan document based on an independent valuation at a very substantial discount to the deal consideration. Are there ways to mitigate the risk of litigation by the former participants who are cashed out through some sort of true-up payment that would be paid by the buyer, which of course would be at the expense of the active ESOP participants who were not cashed out, submitted by Peter? I actually had this scenario a couple of years ago. And fortunately we had a really good independent fiduciary with really good counsel who had been through this before, and he knew how to structure a true-up arrangement. And what we did, my first reaction in that situation was to stop paying out distributions, to do a blackout period and put a hold on distributions so that all the participants would still be in the plan at the time of the sale. However, we didn't know 100% if the sale was going to happen, and also it was a deep, dark secret, so that wasn't going to work. And also it would have been very unsettling to the participants to stop having distributions be paid when scheduled. So we used this true-up arrangement, and in the final deal we had a very, very complicated true-up formula, which I ended up being the one that had to make sure it was written appropriately, and it was one of the toughest things one of the scariest things I've ever had to do. To make sure I understood it and all the impact it was going to have on the plan, and but it does what it does is, and of course in that deal the sum total of all the purchase price won't be known for like 8 or 10 years when the escrow accounts are cleaned out. But if the purchase price ends up being higher than those participants got at the time of their distributions, they'll get a true-up contribution.
Yeah, and Roberta, I have designed similar things like that from a corporate perspective, because whenever there are ESOP distributions that are contemporaneous with the potential sale of the company, and take an extreme example, let's say that you're at $100 a share and I get cashed out as an ESOP participant, and 6 months later I get cashed out at the company is sold for $150 a share. It's really not worth the potential for litigation, and it's also, I think, fair to the ESOP participants to give the true up that you're talking about. The question is, how far do you go? How long do you go? What's the period? Roberta, is it 6 months? Is it longer than that? Is it 3 months? I think it's not an exact science here. There isn't some blueprint under ERISA that tells you what's fair and what works.
You're right that it's not an exact science, but we actually had a way to determine the appropriate true-up period, because there was a point at which we sort of suspected there was going to be a sale, but it was really inchoate, and then there was a point at which we actively we had our input from the investment banker, and we started actually offering, we put the company up at auction, and so the point at which the sale got serious, I believe that was the date we used to begin our true-up, because before that, nobody would reasonably have expected that a sale would happen in the short term. But after that time, somebody might have, and so that's the case we included.
And Roberta, that's consistent with the case law too. There's been some Ninth Circuit case law that's exactly consistent with what you just said, that once there's serious consideration of a sale, that's kind of what triggers it. So I agree, but even in that case, I don't think there's a get out of jail free card there. There's a lot of question about how to apply that and how to apply it fairly, but it sounds like you do it great, and I think that's a good model to use. And it's important, in my opinion, it's really important to make sure that you don't have distributions occurring at differential values approximately close to an ESOP transaction. You're going to have problems if there's a lot of money involved. It's going to be either a DOL lawsuit or a private plaintiff's litigation.
That's all I have. Shall we turn it back to Kelly?
Yeah, that's fine. Kelly, thank you. And Roberta, nice speaking with you today.
Nice speaking with you.
Thank you. A brief announcement. New York and Kansas states require that you record and report the following code to obtain CLE credits for the live or recorded version of this CLE webinar. If you will be requesting CLE credits for this seminar, please write this code down. The code is TLEJRK. That's T like Tango, L like Lima, E like Echo, J like Juliet, R like Romeo, and K like Kilo. Again, that is TLEJRK. All right, so we have 1 or 2 minutes left for any questions. Listeners, you can ask our speakers any questions relevant to today's topic. You may email questions to erisalaw@stratfordpub.com. Submit questions by typing your question into the Q&A box on the bottom left corner of the screen and clicking send. You may also ask a question live by telephone. To do so, press *1 on your touch-tone phone. Again, that's *1. If for any reason you decide not to ask your question, you can press *1 again to exit the question queue. All right. Oh, just one more reminder. If you're asking a question by telephone, please turn off the sound on your desktop. All right, let's see if we have any questions. And it looks like we have no further questions. So we'd like to thank our audience. We hope you have enjoyed our national webinar, Structuring Options for ESOP Transactions, Advanced Techniques for ERISA Counsel and Plan Sponsors, Addressing Regulatory Obstacles, Financing Alternatives, Warrants, Clawbacks, Earnouts, and Other Planning Options. If your question was not answered, you may email it directly to our presenters. Their email addresses are included in the program materials. If you are seeking continuing education credit, you must verify your participation in this webinar by completing and submitting the attendance affirmation or evaluation after the program. A link to this form will be included in the thank you email that you will receive immediately following the program. As long as you have registered and paid for this program by 5 p.m. today, you will receive your certificate of attendance within 24 hours. If you have any questions about continuing education credit for this webinar, please call our continuing education department at 404-881-1141 extension 2. Today's participants can order a recorded version of this event at a special attendee price. Please call customer service at 1-800-926-7926 extension 1 or visit Stratford's website at stratfordpub.com. If you are not yet a Stratford Annual Pass holder, try the CLE Individual Annual Pass. You can get all your CLE credits for one low price. Simply respond to the email you will receive after the program. Stratford would like to thank you for your attendance. To end this call, simply hang up the phone. Thank you and goodbye.